Good morning to you, Brad. Like the new beard you're sporting. We were just talking about that earlier. Good morning to our clients and friends of the firm and my colleagues. So happy 2022. I know we're February 2nd, and today is Groundhog Day as a quick aside. Our talk today is Goodbye, Tina. There is no alternative, and hello, diversification. And just not too very long ago, people thought all you needed was equities. Within equities, maybe you just needed 4 or 5 stocks. So we're going to get into it with Brad. I'm going to say a few words and turn it over to Brad in about probably 5 minutes, 6 minutes. So it is Groundhog Day. Punxsutawney Phil, the groundhog, though, if you don't realize it, is only correct about 39% of the time in his prediction. And it kind of reminds me of a story. A lot of friends that know me casually, they'll say, Mike, you're a wealth management firm. What should I do with my money right now? The Fed just came out with this yesterday or that. What should I invest in right now? And I always respond with a really boring answer. It's a whole bunch of things, and we should know your long-term plan. And we can get you there with probably better accuracy than the 39% that Punxsutawney Phil does and what many traders do by just being a little bit more thoughtful and coming up with a longer-term strategy. So that's my quick intro on that front. I want to just talk a little bit, about some quick stats on Lexington. Lexington was founded some 23 years ago. In some ways, it feels like yesterday, and in some ways, it feels like we've been doing this forever, and it sometimes does feel like Groundhog Day. We advise on about $2.1 billion of client assets. We work with about 998 families. They're in 34 states and 5 countries. And many of our clients' taxes matter a lot. So we focus, maybe we hyper-focus on achieving after-tax returns for our clients. We do that just so they can execute and live their best life and execute on their dreams. We're growing fast. We added 2 local excellent wealth advisory firms joined us last year, adding 8 very excellent, most excellent professionals. We also hired 2 top-notch advisors last year. The answer is yes, we are taking on new clients. Sometimes people ask us if we are, and we're built to take on more clients. And in fact, if any of you are affiliated with nonprofits or anything like that, we also work with a number of not-for-profits. A couple of things that some of you may or may not know. We know we have a bunch of new clients to the firm. We really try to hyper-focus on communication with you. So we do hundreds upon hundreds of client meetings, one-on-one in person, as well as in Zoom. In addition to that, we do a number of webinars and live events. We did 12 Empower Women series events last year, followed with web podcasts. We did 3 live webinars, such as the one you're seeing here today. We do 2 live events, one in the spring, one in the fall. The spring tends to be an event around the heart, we call it, a lifestyle kind of event. And the fall tends to be a more technical event. And don't think of you sitting in a room and you're stuck there for 3 hours. It's a cocktail party followed by a learning event. So people who come to the event seem to love them. Many have met good friends, and it's become a very well sought after event. And I think our clients and friends of the firm have really come to enjoy these events. Speaking of events, we just finished our Race the Arts. We had a cocktail reception for a local artist. And we feature 3 local artists a year in and around Lexington, Mass, up to Southern New Hampshire. We exhibit their artwork in our offices, and then we have an opening night. And it's always a great hit, and it's a great way for people to connect. In terms of additional resources, we are part of Hightower, which is one of the most highly ranked advisory firms in the nation. And with them comes additional resources. So we've recently added a few things which some of you may like to hear about and may take us up on. We now have access to an estate planning group that can help you review your estate planning documents. We can actually even flowchart those documents so you can actually see what you have, because they can sometimes be voluminous. And we'll come in with some recommendations you can then take back to your estate planning attorney and go with that. Hightower did create a trust company. We have 2 trust companies we work with, both Fidelity and Schwab, but there are certain cases where Hightower's trust company may be more relevant to some of your needs. We're working on different ways that we come in with concentrated stocks. There are different ways we can now diversify out of those stock positions. And last but not least, that we have a valuation service where we can do a basic valuation of your company. If it gets more serious, we've formed relationships with firms that can do those valuations. And then from there, if you think of going to market, we've formed 9 relationships with 9 different investment bankers around the country. And we could bring you to 1 or 2 of those that may be an appropriate fit for you. So we have a lot going on. We do have an investment committee at Lexington. We have an executive group of several individuals, followed by a much broader group of just about, I think every advisor is a part of the investment committee. And that group works with a couple of different groups. We work with Hightower. They have a whole investment committee at the Hightower group, and they're doing a lot of work in and around private investments right now. We've really leaned on them quite heavily for access to certain private vehicles, private equity, private debt, private real estate, and the like. And we've also partnered with Fiducient. And Fiducient, I'll turn it over to Brad in a second. He's a partner at Fiducient and the deputy chief investment officer. But they are a very large, well thought of institutional investment consulting firm. And I know Pensions Investment Magazine rates them amongst the best in the country / the world. So we're fortunate to have them here and have them here today. And with that, I'm going to turn it over to you, Brad.
Yeah, appreciate that, Mike. As I was thinking about your fall conference and technical, it sounds like it's cocktail hour, then technical, or is it technical then contact hour? I don't know.
No, it's actually cocktail hour, technical, cocktail, well, maybe coffee.
Got
right?
it. Okay.
And dessert. So it's a respectful cocktail hour.
Yeah, no, I get that. Sometimes the order of operations matters just as much as the operations, but appreciate that intro. So we thought we'd spend a couple of minutes here really talking about our 2023 outlook. As Mike mentioned, we support the Lexington team and the Hightower team, augmenting a lot of the great research they're doing there. Part of that is supplementing things like, what does the future look like in 2023 and beyond? How does that have an influence on our asset allocation? What investment changes should we be making in portfolios? All while considering the things that Mike mentioned, your estate planning, your goals, your long-term plans, and of course, after tax, maximizing after-tax returns. So as we talk about 2023 and the outlook, we'll kind of give you the, call it cruising altitude level, the main themes that are going on in markets that will be driving prices here going forward. And then should you have kind of very specific questions about your portfolio, please feel free to reach out to your advisor. But if you have questions that kind of stay at that high level, feel free to put them in the chat. We're happy to answer them along the way or get to them towards the end. So, as we roll calendar year, we're kind of coming into 2023 here. Mike had given us a kind of a great brief introduction here. And as he mentioned, we are a third-party registered investment advisor, 230 billion, focusing on the institutional market and support many firms like Lexington Wealth Management and Hightower across a variety of different verticals, whether it's asset allocation, investment selection, and really augmenting the good work that the Lexington Investment Committee is doing internally and supplementing those efforts to make sure that we have kind of whatever is out there. The world is our oyster. Can we bring those best investment ideas forward, both in how we construct a portfolio and how we implement a portfolio, to implement those into your individual portfolio. So we take all of those resources. We have 23 dedicated research professionals on staff. We have almost 40 chartered financial analysts within the building. That investment prowess kind of drives a lot of the work that we're doing. And each year we put out our annual outlook. And oftentimes we start to describe our annual outlook in the form of themes, right? What are the main things that are going to be driving markets? There's lots of things, millions of data points, literally every day that we can look at and consider. But a lot of that is noise. Some of that, few items of that are signal, right? So how do we focus on the things that are going to be important? And then how do we make sure we translate those in the best way into our portfolio? So there are 3 things that we really think are going to be most germane and important to you and your portfolio and allocations in 2023. And those 3 components are the following. First is this idea of persistent volatility. Now, don't just package 2022 volatility and lay it on top of 2023. That's not what we're talking about here. But we do think that we're entering, call it a new era, or maybe exiting a unique era in which since 2007, 2008, we've had extraordinarily low interest rates, extraordinary accommodative monetary and fiscal policy. So what are the inferences from that? And we'll talk about that more in a moment, but we think it's going to have important portfolio construction and design inferences in how we build our asset allocation going forward. The second major theme is moderating inflation, and we'll talk about kind of what that means. Now, note, we're not talking about extinguishing inflation or solving inflation in 2023. We're talking about inflation moving from hopefully what we saw as a peak in June towards more modest levels. And the good news for us as investors is we don't have to solve inflation in 2023. We just need a path towards resolution, and we believe we're on that path, and we'll give you a little bit more color as to why. Finally, is this idea of a bear market bottom. Now, those of you that have worked with Lexington Wealth Management over time, we are not market timers. We're not saying, hey, today is February 2nd and today is the bottom, or it's going to be March 15th or November 2nd. Like, that is not what we're saying here. We're saying that, using the resources and the research that we have done, we think we're far closer to the bottom than we are to the beginning of this most recent route. In theory, we could have bottomed in October. We could bottom later this year, but we don't have the power of precision, right? We can't say with the exact date when markets will bottom. So we have prepared, and we are preparing for markets to bottom in our asset allocation, and we're using that power of preparation to build both resiliency in portfolios, that kind of first vertical around persistent volatility, and preparing for markets to rise as we move forward, because we think that there are some pretty interesting opportunities there in 2023 and beyond. So why don't we unpack these quickly and kind of talk a little bit about what each of these mean for your portfolios. So this idea of persistent volatility, again, we have to give ourselves a little bit of context of what we mean by persistent volatility and why is it that just raising interest rates is kind of creating a new regime. Well, it's hard to remember at this point, but going back to 2007, 2008, or the global financial crisis, prior to that, interest rates were materially higher than they were today. Inflation on average was higher. It was a very different environment. But as we entered into that pretty deep, protracted recession, we really had to consider, and the Federal Reserve at the time really took extraordinary measures to try to pull us out of that. In doing so, we entered this kind of new regime of extraordinarily low interest rates. So why don't we draw a little context around what is, air quotes, normal in the economy and markets over time, and where have we been over the last 10 or 15 years, call it. So let's look from January 1955 to February 2006. So what's special about 2006? That's when Ben Bernanke became the chair of the Federal Reserve. He's largely considered the father, or maybe at this point the grandfather, of zero-bound interest rates and quantitative tightening. But in this period of time, let's call this normal, we had an average Fed funds rate of a little over 5.5, 5.6. We had inflation, consumer price index, or CPI, at around 4%. We had GDP growth, or economic growth, of a little under 3.25, 3.23. And the markets, the S&P, annualized at just under 11%, so 11% per year. Now we know those are averages, and the world doesn't live in averages. There are periods of higher inflation and lower inflation, higher returns and lower returns. But let's just use this as that kind of North Star to think about. This is what is more typical in markets. Now let's look at where we've been over the last 15 years. So we've had a Fed funds rate of 1.1. And we know at periods of time, and for extended periods of time, that was actually 0 to 25 basis points. So about as accommodative as we can be. We had inflation of 2.2, so almost just over half of kind of long-term inflation, so very benign inflation. We had sub-trend GDP growth, so just under 2%. Yet the market, the S&P, annualized at almost 15% per year. And so extraordinarily low interest rates, extraordinarily accommodative monetary and fiscal policies certainly helped drive asset prices higher in a market where we didn't really have to worry about inflation. It was kind of fallen out of the lexicon of investing, and that led towards some of these market outcomes. And also, it was a fairly unique period, right? So this chart on the left here is actually in my mind has come to symbolize some of the oddities and unwind of this period. So this is a chart of negative yielding debt around the globe. And first off, that's an odd concept, to pay someone for an investment to then give you your money back later, right? So it's not, you don't have to step back too far to think it's a pretty unique environment we've been living in. But as of 2020, there was almost $18 trillion in negative debt around the globe. And you can see the kind of cascade away from that and that material kind of fall down. And that symbolizes kind of what we're talking about here, exiting this financial repression. But in this period of time, we've also had some other unique market circumstances like meme stocks, right? Where fundamentals of businesses might be modest, but the price of those securities were up hundreds and in some instances thousands of percent. Cryptocurrencies. Now, this isn't a damnation on cryptocurrencies, but I think prior to 2022, there's this floating conversation of cryptocurrencies are not related to the market. They're on a public ledger. They're unique. Well, I think the air came out of that balloon pretty quickly as cryptocurrencies certainly showed the relationship to market in 2022. And then even this idea of negative mortgage rates, right? Where a bank subsidizes the cost for you to go out and purchase a home. It's a pretty odd environment. And so, as we think about kind of this idea of exiting this unique period that we've been in for almost a decade and a half, it has important inferences. The first, as I mentioned, this idea of persistent or higher volatility. So stocks may be more volatile, bonds may be more volatile, and the intersection or the allocation decisions that we make will be even more important. The second primary inference in our view is, the playbook of the last, let's just call it 10 years, was something like just own US stocks, don't own international. Or beyond that, maybe just don't own S&P, own technology stocks. Or just don't own technology stocks, just own the FANG stocks, Facebook, Apple, Amazon, Netflix, Microsoft, et cetera. This idea of kind of hyper concentration was the only ticket to winning. Well, as we exit this period of financial repression and zero bound interest rates, we do think that, that playbook of the last 10 years, for those that just simply try to hit repeat and, put that exact same playbook to work over the following or the coming 10 years, might be sorely disappointed, right? As the environment has changed, as the facts have changed, so do our opinions, right? And so that has pretty profound inferences on how we're allocating to portfolios and what we're doing to best benefit from those changes. So that's kind of the high level on this idea of persistent volatility. And we'll get into, at the risk of bearing the lead, what that will mean for you all and your portfolios going forward. The second major theme, which we talked about, is this idea of moderating inflation. So 2022 was unquestionably the year of inflation, right? And by extension, it was also the year of the Fed. The Fed was very active in raising interest rates in 2022. That had pretty profound effects on the prices of stocks, particularly growth stocks. It had profound effects on the prices of bonds. And so, that driven by inflation, the Fed has had to be a very active participant, raising interest rates over the year by 4.5%. Now, as we look at the trend of inflation, we did see headline inflation peak in June of this year at over 9%. But it's important that as we think about kind of the direction of inflation, we start to unpack that idea a little bit more. So let's just use our most recent data. So December headline inflation, looking back over the year, so the calendar year of 2022 was 6.3%. Now, interestingly enough, this is the stat that, if you pick up CNBC or the newspaper and you look at it, you look at annual inflation. Well, what that is 12 different data points that give you one single number. So if you actually look at if you average that out, we're really looking about 6 months ago on inflation. And so simply just looking at annual inflation is a little bit like driving in the rearview mirror. So we do have monthly information, but it's also a little dubious to just take 1 month and call it a trend. So let's experiment a little bit here and if we just look at the last 3 months of inflation and then annualize that to make it look like this annual number, what does that look like? Well, if we look at annual core CPI inflation, but just over the last 3 months, there's actually only 1.8%. So we've clearly seen a slowing of prices. Now, again, that does not mean that inflation is a thing of the past and we're going straight to the Fed's target, but it does mean that recent price trend has been materially slowing. The other kind of bugaboo with inflation, especially CPI, is this idea around housing. The Bureau of Labor Statistics calculates housing in a pretty unique way because not all Americans own a home. So you can't just simply look at the price of homes and use that as part of inflation. So because there's somewhat of a lagged effect there, for purposes of looking at the direction of inflation, we actually also looked at inflation less shelter, or basically holding shelter flat. So annualized over 2022, inflation was up less, up 5.8%. So definitely a material change. Now, if we again look at that kind of shorter term, more recent inflation, and then annualize it or gross it up and make it look like a year-long inflation, inflation has actually fallen 1.6%. Right. So this idea of moderating inflation, the primary inference here is it also leads to a moderating Fed. The Fed materially increasing interest rates has been a material headwind for stock prices, for bond prices across 2022. If the Fed has the opportunity to, at the very least, step out of the way, they don't even have to decrease interest rates, but just step out of the way, that can help create a market bottom here and build a better foundation for forward-looking investment opportunities and rising prices. So we're beginning to see the seeds are sowing here for moderating inflation, and that's helpful for us as we think about future opportunities. Which brings us to kind of our final theme here on 2023. It's this idea of a market bottom. And again, not trying to be precisely timing markets. Now, stick with me here. This is a little technical, but we'll try to break it down in a way that makes a lot of sense. If you actually look at the price of the S&P 500, there's really two things that underlie that price. The first is the earnings that businesses create. So you're Microsoft, you sell a product, after all your costs, you then have your earnings at the end of the day. If you add all those up, that's the earnings per share of the S&P 500. Then investors will say, how much am I willing to pay for those earnings? So they'll pay some multiple on that. They'll pay more when they're optimistic and they think growth is high. They'll pay less when they're pessimistic and they think growth is lower. If we look at earnings, which is this light blue line over 2022, and just for disclosure, this is through the third quarter of 2022 because we don't have fourth quarter data fully yet. Earnings were up. Actually, they were positive for the year, and just slightly. Now that's kind of counterintuitive. You're like, well, the market was way down. So what's the difference? Multiples. Investors were far less willing to pay higher prices for stocks. And so you can actually see the green line here is multiples kind of fell through the floor, and that drove down prices. Now, as we think about bear markets and market pullbacks, there's kind of three phases, if you will, to a typical bear market. The first is multiples tend to pull back. Why? Why is that first? Because they're immediately reflected. Our opinions, our feelings can change on a dime, and we can see it in price immediately, and that shows up. The next, if the Fed is an active participant in the market, and sometimes they are during bear markets and sometimes they aren't, we know that they have been an active participant in our recent market route. They tend to, if they're increasing interest rates and during a bear market, they'll tend to either stop or pause basically, or pivot. And we're starting to see the first inklings of that. But just for context, throughout history in bear markets of pullbacks of 20% or more, there's never been a market bottom while the Fed has been actively raising interest rates. Now, that's not a law of physics. It could certainly happen this time, but to give you some sense, it still gives the old adage, don't fight the Fed. So phase one is earnings fall. Phase two is the Fed kind of has to get out of the way. Phase one is multiples fall. Phase two is the Fed gets out of the way. Phase three, which is the most lagged, is earnings, the earnings of businesses, what their productivity. Well, 2022 is a year of higher wages and costs, higher interest rates, and those things are beginning to flow through to the underlying success or earnings of a business. Now, one of the reasons this blue line is flat is because of energy. Russia invaded Ukraine, energy earnings went way up, and that's a pretty exogenous event. It's unique. So why don't we carve out earnings from energy quickly, because they're up almost 140% in 2022, and look at the rest of the economy and see how it looks. Well, actually, earnings for everything else, X energy, through the third quarter of 2022, were actually down about 5%. So they're starting to reflect And this is in a good way, right? Because earnings really have to meet expectations in order for us to find a market bottom. They're starting to reflect some of the malaise that we were experiencing 2022 with higher wages and higher costs and input costs. So let's put that in context. If we look at pullbacks throughout history, earnings usually kind of go from peak to trough. On average, they fall about 13%. So we're kind of on our way there. We're making headway towards, again, kind of getting closer to the end than we are to the beginning around earnings, and that creates better entry prices and better opportunities to buy. Now, the big difference here, though, when it comes to earnings, is there are recession pullbacks and there are kind of classical, market pullbacks. The difference in earnings is material, right? So it's kind of for the deep protracted recessions, you get earnings actually fall almost 25, a little over 25%. Whereas in kind of more classical pullbacks, you get, earnings fall far more modestly. Now, if you're saying, hey, bear market bottom, that's one of your themes. One of the bets, if you will, that we're making in portfolios is that if we see a recession, and I know we'll probably have some questions on that, and I'll pause right after this, Mike, and we'll see what kind of questions are out there and for you all as well. If we think we see a recession, which jury's out on if that happens or not, that it won't be a deep existential, kind of the sky is falling type recession like we saw in 2007, 2008. The question is, Bear Stearns fails, then Lehman Brothers fails, then who's next, and the financial system is collapsing. Whereas if we do see a recession, it'll be more kind of classical or cyclically led, which is normal. And companies, consumers got a little bit too far out over their skis, spent too much, that kind of pulls back in. And so we'll probably live somewhere in the middle of these two figures. And that means, again, we're far closer to the bottom than we are or the end than we are to the beginning of finding a bear market bottom, and it creates real opportunity for us in positioning portfolios. So with that, Mike, and kind of have gone through themes, why don't we pause and see what kind of questions have come in, and then we'll go from there.
Fantastic, thank you. So I'm going to throw some questions out to you and think of it as a lightning round, right? We're going to try to cover a fair amount of turf in about 7, maybe 8 minutes to bring this thing in at 35, 36 minutes overall. So let's talk about recession, the big recession, little recession. I think you hit the big R, the little R. So, a lot of people have the mentality, I've got an extra $2-3 million to invest, but I'm going to wait, let the recession hit, then I'll put the money in afterwards, right? You probably heard that once or twice before, perhaps, right? So discuss the big R, little R, then talk a little bit about the market timing. That people they don't like to call it market timing. They like to say, hey, we're just going to wait a little bit till things get better.
Yeah, just wait. Big R, little R, we talked a little bit about that, right? This idea of recency bias, through a manufactured recession where we shut down the global economy through COVID. It's a pretty extreme event. 2007, 2008, the global financial crisis, right? This kind of systemic risk. As we start to go back over recent memory, we've kind of trained ourselves to think recessions are these big, huge events. And don't get me wrong, recessions are recessions. We saw it, and we've been seeing it in headlines. Unemployment has been increasing. Amazon, Apple, Meta, right? They're all laying off. Like these are impactful to people. So we don't want to minimize that. But it also doesn't have to be kind of unemployment rising to 15+% that we saw, as we shut down the economy in a number of months during, COVID, or, when the global financial crisis came along, right? It can be more classically or moderate led recessions. And so we think a small R is far more likely. But also to your point on, kind of waiting for the all clear signal, like, I think we have to normalize a little bit of like, what are recessions? And we kind of lovingly dub this as the recession red herring for a couple of reasons. But first, let's talk about like the economy, right? The economy doesn't grow linearly. It tends to be up and down. It has points of growth, it has points of recession, et cetera. So, if we look at recent trends, and this is leading economic indicators, it's a bunch of things cobbled together to say, is the economy moving in a positive or negative direction? Oftentimes, 9 months after leading economic indicators, there's a recession that follows. So there are plenty of other statistics that you can look at. kind of farmer's almanac, if you will, the inverted yield curve. But there are many of these say it's like, hey, a recession could be coming, may be coming, is coming, depending on your opinion. But recessions are a normal part of the economy, a normal part of investing. They happen on average about every 6.5 years. And so to think like, hey, I really need to avoid this. All the long-term stats on success that you see around investing, right? The growth and wealth and how it's beneficial over time, those include recessions. Those include periods of economic drawback, include periods of market drawback. And so this is normal. It was built into the plan when we first started. Now, this is the important part as we think about, okay, I got a little extra money on the side, like, or whatever the circumstance is, I'm just going to wait until the recession goes by. Well, markets and economies are related, but they're not twins. They're more like cousins. And so you can see these two lines are close or related to one another, but they're not overlapping. So the green line is the economy, and the, call it blue line, I'm colorblind, so stick with me, is the market. Markets tend to peak 7 months before the economy, and they tend to bottom 3 months before the economy bottoms. And so if we were to, let's just say, wait around and say, we're going to wait for the all clear horn on recession, we're going to wait for the all clear horn on inflation, we're going to wait for the all clear horn on earnings, markets are highly likely to have already moved ahead of that. And especially for investors at these periods of volatile time, a lot of the benefit, so much of the total return achieved over time happens in kind of these bear market bottoms. So if you miss just some of the best days, it materially eats into future success. So if we wait for the all clear horn, we're probably going to miss it. And we're not just going to like miss a little bit of it. The risk is we miss a lot of it, even though it's just a short window in time, because markets can move pretty materially. And we've already seen some of those type of returns in the fourth quarter and even year to date to start.
Great. Staying with that theme of, we'll do the Debbie Downers first, and we'll move on to a couple of other things. Let's talk about the budget impasse, the debt ceiling. I know there's a big meeting yesterday in Washington. It's going to be in the news, I'm sure, all spring into the summer. And people will probably harken back to 2011. I think it's 11 is when it last happened.
Yep.
It's happened several times along the way, but that was the last big one that somewhat impacted markets. Your thoughts around that?
Yeah, it's unfortunate, right? So taking aside government debt and kind of role of government and indebtedness, right? The debt ceiling simply exists, came into existence in 1917 around World War II. We've already passed a budget. We're already spending. This is just allowing us to, basically make good on what we've already spent. 2011, we saw a debt ceiling impasse. Markets, S&P downgraded US debt. Markets fell about 17% in 11 trading days. 2013, we saw it again, where the government actually shut down for about 16 days, and we saw furloughs. So it's a manufactured crisis. And given how partisan politics has been recently, it seems more likely than not that, as Treasury Secretary Janet Yellen said, we've got till about June to figure this out.
Mm-hmm.
We're probably going to wait until June to figure it out. The big news here, though, is one, it's a manufactured crisis. And so the resolution of that can also be manufactured fairly quickly. Two, when it comes to debt crises, there's a big difference between insolvency and willingness. So if you look at emerging countries that have an inability to pay their debt, that is a massive influence on the economy, the markets, et cetera. This isn't an inability, it's a willingness, right? So while it's not good, it's less likely to create a massive market moving event. So punchline is we probably think it's more noise than it is signal, especially since today it could be resolved and it could be gone, or it could turn into real brinksmanship. And in June, we have a lot of volatility. Either way, we can't really predict or time that. And so we think kind of building a portfolio to lead through that rather than trying to time it is far more positive.
We would agree. I'll throw another question at you real quick. So the markets and the Fed seem to have some disconnect right now, right? Fed basically got raised yesterday. They're talking about a few more increases, and the market once again rallied, right? So I think the futures market doesn't quite believe what the Fed is saying. your thoughts around that, or should we be thinking about that?
No, it's a very fair point. You know, the market obviously does not believe the Fed. If you look at futures, so the market's expectations of Fed actions, they think there's going to be one more 25 basis point raise, and then by the end of the year, we'll actually be cutting. Now, futures are not great predictors either of the future, ironically, but they show where market sentiment is. Now, let's take the flip side of that. 5 weeks before the Fed made its first 75 basis point move, Jerome Powell in a conference said 75 basis points is not on the table. And then they moved 75 basis points, and then they did it again, and then they did it again, right? So that's why the Fed can kind of bail themselves out and saying, oh, we're data dependent, because the Fed doesn't even know what the future holds, right? They don't have a crystal ball somewhere in the back, right? So when the Fed says we're going to be at 5 and we're going to stay at 5, and the market says we don't believe you, the reality probably lives somewhere in between, because the Fed neither knows nor does the market. What the Fed is trying to do is anchor expectations that inflation is important, because if Jerome Powell is trying to beat anyone, he wants to be Paul Volcker. He wants to solve inflation. He doesn't want to be Robert Burns, which is Paul Volcker's predecessor, who started to fix inflation, but then blinked, and then the market ran off again and inflation went wild. He wants to do it kind of in a one and done. And so he's trying to run a hard line. We'll see how long he can stick with it. My guess is if we get to the end of 2022, if we do have a recession, if markets are way down, if unemployment's way up, they'll probably blink, and begin to cut. But the truth probably lies in the middle.
Okay. Last question, and hopefully we'll leave it at this. Give a short defense of diversification, especially with where we sit right now. I know when we look at your long-term capital market assumptions, fixed income seems like it's no longer a dead asset class. International and emerging markets are looking more encouraging than they have in a decade. And several other asset classes look like they're really valid in terms of helping diversify and grow a portfolio. So I'll throw it over to you and let us end on your word.
Yeah, it's diversification has kind of been a dirty word, right, for 10 years, right? As we mentioned, concentration, and especially concentration in a few type of names or sectors or even geographies, was the winner. S&P outperformed, technology outperformed, FANGs outperformed. As that begins to unwind, right? And we just know kind of, if you just use common sense, right? Or if you use history as a guide, it's unlikely that the same 5 stocks that have outperformed over the last 10 years will just continue to rule the roost year over year, decade over decade, right? There tends to be changes in leadership. So what do those changes provide? As they provide opportunity. So the 3 opportunities we leave you with today. Fixed income is a different conversation today than it was at the end of 2022, or I'm sorry, at the end of 2021. Interest rates were extremely low. The Fed was just embarking on its rate hiking campaign. It was a very difficult market for fixed income, but a lot of that pain was all felt in 2022. Now, fixed income, investment grade bonds, yield 4.5%, 5%. Those are levels we haven't seen prior to really 2007. And that means that you can have a reasonable rate of return, likely above inflation over the long term, without taking on tons of risk. So in fixed income is a different, it's a totally new asset class, and it's a different conversation, and we think can really build benefit in portfolios. The second idea is international has kind of been left for dead for a long period of time, and you can kind of pick your reason why. The primary reasons are the US dollar has been extremely strong, and earnings growth in the United States has been far stronger than it has been inside the United States, because the United States is very heavy in technology and healthcare relative to the rest of the world, and those have been the winners. If you get a reversal or even a slowing of any of that, you can see a material sea change and opportunity outside of the United States. Let's just take the fourth quarter as an example, and a quarter does not make a trend, but dollar weakened, low valuations outside of the United States. EFI, developed international, the market in which there's an active ground war for the first time since World War II, was up 17% in the fourth quarter, and the S&P was up 7%. So it's just an example of how international might actually come back into portfolios, and we think maintaining a position there can definitely add value going forward. And then small caps here in the United States, small cap securities, again, concentration of success has been in the biggest of the big of tech.
Mhm.
As that unwinds, as leadership changes, that creates new opportunities. Small cap today is historically one of the cheapest positions it's been relative to its own history and relative to large caps, providing real opportunity in kind of this period of change. So as we think about the inferences of what's happening in markets, it's really laying the seeds and sowing the seeds for great opportunities to lean into some of these, doing it in a risk-controlled way and leaning out of some of the risks and taking advantage of some of those changes. So it's a different market today than it was at the end of last year, and we're positioning portfolios ahead of that to take advantage of it.
That's excellent. So I think of a quote. Winston Churchill once said, democracy is the worst form of government, except for every other. And diversification may be the worst form of investing, except for every other. So I really believe it's the way to go, especially if you've built some wealth over a series of years. You want to protect and preserve and grow that. So I encourage all of our clients and friends of the firm to reach out to their advisors with any questions. I also suggest that you reach out to your advisor and rerun your financial plan, or at least the Monte Carlo simulation we do around it. I'm finding a lot of clients are pleasantly surprised coming in this year. Their portfolios are down a bit, yet when they run the plan with current capital market assumptions, which are much rosier than they were a year ago, they're finding the rate of success is very, very good. So I think that's encouraging, but I encourage you to walk through and look at those numbers and do it for yourself. Brett, thank you for your time. Really appreciate it. Great seeing you once again.
All right. Thanks, Mike.
Take care. Have a great day. Stay warm.